It's February 21, 2009. It's Maximize Utility. I want to talk about investing in gold. And I'm going to tell you that it's another one of those investing techniques that you're not generally going to beat the market doing. You might get lucky and buy gold when it's going up. You might get unlucky and buy when it's going down. But there's no way to discern its turns and trends. There are a lot of people out there who are big gold investors. You might call them gold bugs, and they contend that they beat the market. I think so many people do it that some of them invariably do get lucky for periods of time, but in general it's an impossible series to predict. Gold's been in the news a lot lately. It in fact broke $1,000 per ounce yesterday on February 20th, and it's up about 50% in the last 4 months. Now, that's a very, very basic bet. People are looking at the fiscal and monetary policy of the United States and saying the United States is going to run high inflation, and they're thinking that gold will become valuable in the future. Simultaneously, though, some people say we're looking at deflation, and if there's deflation, gold should be less valuable. I would say it's a toss-up, although I think there's a definite inflation bias in the long run. But what happens with gold is that so many people get into it that you've got to wonder if they get out of it. What will happen to the price in a shorter term, the term period in which you might buy the gold. I've read that the University of Notre Dame endowment has put about $100 million in gold, and that certain hedge funds have also put a lot of money in gold lately. And if they decide to get out after making a little bit of profit, you might be on a downswing. Now, some people love gold and they think it's something that stands time immemorial. They say things like gold should be part of any portfolio, or that gold is the only asset that is not matched by a liability, or that gold is the only asset that's held its value for thousands of years. And those things may be true in a sense, but economists will tell you, and they've been saying this for a long time, that gold is really a defunct asset, that it's not really needed as a store of value the way it was in previous times. But you can make a case that maybe it is now. Maybe the U.S. government and the governments are doing such loose monetary policy that we'll enter a period of high inflation. So what I want to do is tell you a little bit of history of gold and a little bit of the basic economics of it. And then I'll list what I think are the major economic factors that move the price of gold, and I'll show you how hard they are to predict. During the 1800s and for much of the 1900s, the United States and other countries were in gold standards, which meant that they stood ready to give you gold for their currencies. And that was very successful in keeping inflation moderate. Over the 1800s, for example, prices actually went down. Now, as of 1934, the U.S. said it would give you 1 ounce of gold for every $35 of currency. And that standard, or that willingness to convert into gold, stood until about 1971, when the U.S. suspended converting dollars into gold. Now, immediately, the price of gold surged to about $100 per ounce. Then the gold price continued to go up during the 1970s, which was a decade of high inflation and economic distress. And it hit about $850 per ounce in January 1980. And that would be a high price. And in today's dollars, that would be about $2,000 per ounce. Now, some amateurs in gold investment, they don't even understand that concept. But in fact, gold at $1,000 today is less than it was around 1980, when it was $850 per ounce, at least in real terms. And then gold started on a decline, and it declined in the 1990s to a low of about $252 per ounce in June 1999. At this time, central banks were selling their gold, and it looked like they would continue to do so, but they cracked an agreement not to sell gold, and that trued up the price. Now, if you were lucky and you got into gold investing around the early 2000s, since about September 11, 2001, you would have seen a resurgence in the price of gold. And now we see that it's hit $1,000. Last year it hit $1,000. And it seems like right now is a key time for gold to keep going up, because among other things, you have economic calamity, and you also have the potential for high inflation. So the price of gold has gone nowhere in almost 30 years, yet you have these gold bulls out there who claim they made a lot of money, perhaps. Now, I already recited some of the cliches they use. Gold is the only asset that's not matched by a liability. But if you want to be somewhat more scientific about it, what are the factors that move the price of gold? I'll give you a lengthy list, and I'll tell you that they're all impossible to understand themselves. It's mining production. It's surprisingly hard to know how much production is being done and how much can be done, how much can be ramped up quickly. There's demand, in particular jewelry demand. That's the key demand for gold. Maybe about 60% of the demand for gold is for jewelry. And that's been declining a little bit because the economies are in weak shape and the consumers aren't that rich, particularly Chinese and Indians and Americans. Now, that's a guess what's going to happen to the economies and how much money people are going to have to spend on jewelry. The value of the dollar. The train of thinking is something like this. If the dollar goes up, people demand more dollar-denominated assets, therefore they demand less gold. Now, the dollar could crash because the U.S. is doing loose monetary policy, but that's a guess also. Inflation. High inflation means go to gold. And it looks like we'll have inflation. I think we probably will. But if the economy stays really poor for a long time, you could have deflation, at least for a long enough time. Now, the key thing about gold is usually war and turmoil. And right now, we're in the greatest of financial crises we've generally seen for a while. And the price of gold has gone up somewhat, but remarkably, it hasn't gone up that much. And anyway, predicting war and turmoil and financial crisis and terrorism, that's very, very hard to do. And I'll tell you this, minor geopolitical crises, wars and terrorist attacks and so on, they won't move the price of gold at all. You have to do something really big, and something really big is altogether impossible to predict. Another thing is the trends by buyers and sellers, like these big hedge funds I was talking about and these big endowments. You don't know really what they're thinking. They're looking at all those other factors and trying to make guesses about those. Another key thing is the sales by central banks, or the holdings by central banks. They haven't been selling lately, but you never know when a country's going to say, hey, screw it. We need the money. Let's sell gold now while it's $1,000 an ounce. And in general, the strength of the economy is a key. That's somewhat redundant with the other things I said, but we don't know where the economy is going to go. And another thing is the value of substitute assets. High values expected in these assets mean stay away from gold. But what do we think is going to happen to the stock market? That's another guess. So you can see there are a lot of factors, but they're all themselves hard to quantify. Those are the myriad factors that affect the price of gold. And anybody can make guesses about what's going to happen. Will the central banks decide to sell? The price is high. Is this recession so strong and so long that people in India and China and the United States will start buying gold jewelry? Now, here's the problem. You're not supposed to say this if you're a social scientist. There's too much data out there. You can get data on almost all these things and then make guesses about which factor is going to dominate. There's a website, www.gold.org. It's the website of the World Gold Council. And they have all kinds of data and all kinds of links and all kinds of research. It kind of sucks the fun out of everything. But you quickly realize that if you're investing in gold, you're making bets about what other people think is going to happen to it based on bets about what they think is going to happen to the economy. Gold investing, do it for fun, sure. I didn't talk about the ways to do it. There are lots of ways to do it today. You can buy the bullion or the coins. You can do it through exchange-traded funds. That's an easy way to do it in your regular stock trading account. It used to be you have to open a commodities account. That's a more high-power way to do it. And you can do tangential things like buy gold mining company stocks and so on. But definitely do it for fun. I think I showed there are so many factors out there. We know so much about it. It's really anticipating what people are thinking about it rather than the thing itself. So do it for fun. Maximize utility.